Good afternoon, everyone. We are team number 2. These are my teammates, Casper and Jillian. My name is Zorian, and today we are going to be informing you all about BL Investment Management Firm. BL Investment Management Firm is a company strongly known for its commitments to ethics, integrity, and client care. However, what you'll notice throughout this case is that they did everything but that. In a recent discussion held between its CIO Ribeiro and his subordinates, a decision was made that could permanently jeopardize the company's overall well-known reputation. It starts with the misguided tone at the top. CIO Ribeiro failed to set an ethical framework that could be replicated throughout the company. Next, there was a huge breach of fiduciary duties along with a breach of securities law. You may be asking yourself, what exactly happened that led up to this unethical behavior? I will tell you. Starting with the misaligned compensation plan that basically rewarded employees for promoting certain products. The second thing would be the CID accounts, which allowed advisors to make investment decisions without the client's knowledge or approval. And lastly, Prodigia, which had been one of the firm's more popular mutual funds, had been favored over others without the customers knowing or having any input. The center of all issues, however, was the misaligned compensation structure. On the surface, it was harmless and even innocent, as it was meant to boost productivity and also increase firm growth. However, it did the complete opposite, as you may know. It provided a bonus system that benefited advisors' needs over the client's needs. This whole entire compensation structure violated standard 3A, which was the loyalty, prudence, and care, by simply rewarding advisors for not remaining objective when dealing with clients. Secondly, it also broke standard 6A, which was the disclosure of conflicts. And the firm broke it when it failed to disclose to clients that advisors were actively being compensated for pushing out Prodigia mutual funds. Next, my teammate Casper is going to elaborate a bit more on that.
Thank you. So now that Ryan has outlined the compensation plan a little bit, you may still be wondering what is actually so problematic about it. It's of course okay to reward advisors based on performance through a variable component, but when it's used in conjunction with assets such as the CID accounts, it can cause advisors like Bianchi to act outside of the interest of their clients. The new CID accounts are annual AUM-based, fee-based accounts that replace traditional commission-based brokerage accounts and were pushed to clients as a less expensive alternative for buy and hold investors. Bianchi incrementally converted their clients' brokerage accounts into these new CID accounts based on their AUM. While the switch was presented as a benefit to clients, it was actually quite deceptive and a complete breach of trust and a clear breach of Code 1C, the misrepresentation clause of the Professionalism Code and Fair Dealing. Here's why. The CID account's simple annual fee was actually just a smokescreen, as it distracted clients from the crucial fact that this fee didn't include the internal fees that lie beneath. This is where the new compensation plan becomes so problematic. According to the new compensation plan, an advisor's bonus wasn't tied to the CID fee, it was actually tied to a 10% increase in BLM's total fee revenue. So since advisors couldn't change the CID fee, the only way to hit their bonus targets was to maximize the fees generated within the account, which compromises Code 3C, their duties to clients, and finding what is best suitable for them, as well as a failure to disclose conflicts of interest. This situation is further exacerbated by the Prodigia partnership. This new bonus plan only works if they have a menu of high-cost, high-fee products to sell. This is where the Prodigia agreement comes in. This deal, negotiated by Ribeiro, is what further encouraged the high-cost rule for this new compensation plan. BLIM took a $5 million payment from Prodigia, where in exchange, BLIM would provide these mutual funds to clients. And these mutual funds were made up of various share classes with different fee structures for certain clients of different qualities. This is okay if there's transparency, however, there was none. The different fee structures that were not at all disclosed to the clients left them in the dark as to what was actually best for them, which is a clear violation of Independence 1B and Suitability 3C. Additionally, they also deliberately hid this entire agreement from their clients, which is a clear and obvious breach of loyalty and disclosure of conflicts. Even worse, to ensure this deceptive new model was adopted firm-wide, Ribeiro told Bianchi that he would share the client-facing fee schedule with all other advisors to maximize fee revenue and increase profitability. Additionally, as part of the deal as well, Riviera also admitted to giving BLM's confidential client sales to Paragia, which is a complete betrayal of client trust, using their private information for commercial gain without their permission, a clear violation of Code 3E, preservation of confidentiality. Finally, this agreement also laid the groundwork for collusion, which Jillian will get in more depth with now.
Wow, you might be wondering, could it get any worse? Unfortunately, it does. Like Casper had mentioned, there was collusion happening between Lopez, the mutual funds manager from Prodigia, and Diego, an investment advisor at BL Investments. And in the process of this collusion, they committed 2 illegal acts: front-running and late trading. So what happened was Lopez would allow Diego's clients who invested in Class A shares the ability to sell those same shares at the current closing day price instead of the next day. Now, the clients who were allowed to do this had to have invested more than $100,000 in these Class A shares, and once they did, they were able to get this privileged information. This is late trading and violates securities law rule 22C1. Now, we believe that they chose the Class A shares because it has the highest annual fee attached to it, and like how Zoe mentioned, that goes directly into Diego's bonus. Now, on top of this, Lopez would also call Diego when he was about to execute a large block trade. Then Diego would relay this non-public material information to those select clients so they may have the opportunity to act before he did. This is front-running and violates securities law 10b-5. So, and on top of the security breaches, Diego also violates numerous CFA ethics codes such as knowledge of the law, misconduct, competence, loyalty, prudence, and care, avoid and disclose, as well as integrity of capital markets. Now, even if his clients didn't partake in this scandal, he made sure to take full advantage of this information and use it for his personal portfolio, further violating duties to employers' loyalty and conduct as CFA participants. Now, Lopez was also a perpetrator in this scandal. He was the one orchestrating the insider trading. He was providing the non-public material information, which he again violated securities law 10b-5 and 22c1. Now, he was also in breach of his fiduciary duties because he was providing preferred pricing as well as sending out his company's fund information, which violates preservation of confidentiality, duties to clients, integrity of capital markets, and duties to employers. Now, Bianchi and Ribeiro are also involved in this because Diego had disclosed this arrangement with them, so the liability now extends to them. As CFA members, they should have reported this right away, but instead they wanted in on the arrangement, further violating knowledge of the law, misconduct, and non-material information. Now, all 4 actors violated duties to employers' loyalty. For Bianchi and Diego, it was to BL Investments. For Lopez, it was to Prodigia Group. And for Ribeiro, it was to the parent company. Ribeiro also violated responsibilities to supervisors because he should report them as conduct. Now, you've heard us talk about all these ethical violations that the company has violated. And we've summarized it in this matrix for you all with the 4 actors and the 7 standards here and the X's representing violations. As you can see, Diego has the most violations, but what's even more concerning is Ribeiro. Even though he has less, he still has a significant number of ethical violations, and like how we stated in the beginning, this is clearly showing the misguided tone at the top we were talking about, and it's causing his advisors to do the same. So there needs to be change, and these are our recommendations to do so. To resolve the misguided tone at the top, we just believe they need to replace Ribeiro as the current CIO. He is providing unethical behavior and is influencing his advisors to do the same. In terms of the misaligned compensation structure that Zoe talked about, the variability of the compensation plan isn't really the problem. It's the bonus that's attached to it. So we believe the annual fee should not be what is incentivizing them. It should be something more along the lines of client satisfaction rates. And to avoid any account requirements and the inconsistent client delivery Casper touched on, there needs to be required documentation of how the advisors got to their conclusion, as well as continuous review of that documentation so there's continuous oversight. And as you saw in the matrix, there's obviously a knowledge gap between what's ethical and not based off the CFA ethics codes, so there needs to be some mandatory ethics training. And for the insider trading, what we recommend is a reporting system. We would recommend an AI reporting system called Guardian AI, where it would promote whistleblowing, where an employee could go in and anonymously tip off if there is any illegal acts or if there is any ethical breaches. And then the platform can also be used to tell a employee if something is ethical or not, and its basis will be off
That's
of the
fine.
CFA standards. Thank you.
Awesome. Great work.
Thank you.
Good job.
Yeah, good job, guys. Could you, a large section of the case was dedicated to the client matrix with the different share classes.
Mhm.
Could you dive a little bit more into detail? It was in the beginning of your slides, but
Yes.
into more detail, the differences and in those share classes and what violations come up potentially from that or not come up from that as well.
Yeah. Yes. So we actually want to have a whole section about this. The fee schedule is pretty problematic as it separates the clients based on their asset under management. So those with higher AUMs would get different kind of treatment, a different share class, which is a violation of, for example, fair dealing, as well as loyalty, prudence, and care, and also finding the suitability for their clients as well, which is 3C. So there's a bunch of different discriminatory aspects of the share class, which, like I said, is okay if it's shared with the clients, but it was not at all disclosed at all, which is also a failure of disclosure of conflicts of interest, which is 6A.
Yeah, to add on to that, by keeping the customers in the dark about the whole matrix, it violates trust and transparency amongst the clients. You know, they're being sold something and they don't fully know what they're buying into. And with the agreement, it would definitely violate independence and objectivity and misrepresentation as well.
And kind of bouncing off what both of them said, yeah, absolutely. Like, despite different clients having different sorts of incomes, if that isn't made transparent, if it's not being made clear to the people actually investing money into BLIM, that can disrupt the entire flow and trust that is needed for customers to continue to, or clients to continue to do business with them. So it hurts the firm long term.
One of the things you mentioned was on annuitizing. You said that maybe it's not a good idea to annuitize everybody, but you should maybe look at client satisfaction. I think that's the way you phrased it. What could I look at to quantify why I should annuitize somebody or not annuitize somebody? And on top of that, was there a schedule that they were proposing to annuitize all the clients? And what are your thoughts on that schedule? I think it was first quarter, second quarter, and it was also on the size of the clients. Do you have any thoughts on that schedule?
It's a great question.
Yeah.
So you want to know about why the bonus incentive and then why they did it per quarter?
I want to know what kind of clients should not be annuitized,
Oh, okay.
and why some clients should be annuitized. What is it about the account size, the account trading?
Yeah.
What are some qualities that would make a non-annuitized account make more sense than wrapping it?
So in the case they mentioned, there was income-oriented clients versus not, and with the CID accounts, the problem was Bianchi was requiring them all to open those, but then close the existing brokerage accounts. So then for those income-oriented clients, it wasn't great for them because if their strategy is to buy, sell, and hold, then they're going to want those brokerage accounts. So forcing them to do one thing over another wasn't great. Yeah.
Okay, and what are your thoughts on that calendar of
Yeah.
The quarterly shift to annuitization?
Quarterly shift to annuitization.
Okay, we can move
Yeah,
on.
sorry.
You guys don't have any thoughts on that? It's fine. We have a limited time, so we'll just keep going.
Yeah, kind of go into the beginning of the case of kind of similar topic about the different account types of the clients. What are your thoughts on how, they were handling family members of an employees type accounts and kind of, your kind of perspective on that?
Yes, there were a lot of differences. Obviously, some of the advisors who had access to, or who were bringing their family on it, they had some unfair advantages, for example, with the insider trading violations. And there was also the issue of certain clients, based on their AUM, would get certain treatment. Like, for example, communication was a big one where those with more investment knowledge are typically the ones with higher AUMs, and they would get less communication, or communication that was less clear, perhaps just through emails a couple times a year or a quarter or whatever, instead of it being a fair dealing with everyone. So communication was pretty inconsistent in terms of if they were related to them, or if they're different qualities, like I mentioned in my slide as well.
Yeah, kind of bouncing off what he said, everything needs to be consistent. When you're running a firm, you should never do you should never show preferential treatment just because somebody is related to you. That completely is a breach of trust, and it goes against the one thing that all of those CFA members signed up for when they became CFAs.
Yeah, and that also ties in with the 80-20 rule that they had, where 20% of clients would provide 80% of the revenue, which was kind of just an arbitrary rule that justified their unfair dealings.
Yeah.
So there's a lot of breaches there with conflicts of interest and their duties to clients, as well as a lack of investment analysis as well at multiple levels.
Can I treat a large client preferentially different than a smaller client? What are some ways that I can give preferential treatment to a $100 million client versus a $1 million client? Can I put them in different share classes? When can I do that? Is there anything else I can do that would not violate some of these standards?
It's a good question. I think it's generally okay, to be honest. Like, it's as long as it's transparent, essentially. Like, if they're paying for that kind of preferential treatment, then it's fine. But if it is used in a way to generate those extra fees for the advisors because it would boost their paycheck, then that's obviously totally unfair. But it's mostly about transparency and disclosing their conflicts of interest as well. I don't know if you have anything to add on.
I think with the share classes, how they did, if a client has more funds that they just have, and then you have to manage more of them, they might have to spend more time on that client than someone who has less than $25 million.
Yes.
So I think that's fine. Like Casper said, the conflicts of interest and things being tied to those annual fees, and that could cause violations of independence and objectivity. So that's where it kind of muddies the water, I think.
Yeah, and like you said, spending more time on those with AUMs is fine, but it was actually the opposite in the case. They wanted to spend as little time as possible communicating with them because of their investment knowledge and such, so they couldn't, see behind the closed doors and actually see the client-facing fee schedule and what was actually best for them. That's what it boils down to.
All right, thank you.
Yeah,
Good job.
thank you.
Thank you.
Thank you.